Hey everyone, today is 8/27/25. We're gonna go over portfolio overview, and also I'll show you how to manage a losing options position. So in this case, it would be with Cracker Barrel. I put in a call credit spread, and the position moved against me, so I'm going to have to close it, and I'll open up a new one at a higher strike price range. So first of all, portfolio buying power. This used to say like around 500 bucks. I had to put in some more money just to mess with that options position. You can see past week pretty flat, past month flat, up slightly past 3 months, and for 2025 we're up 4.28%, which pretty much is around what you would get if you invested in a really good high yield savings account. But it has been up to 5% recently, which I don't think any savings account would have that. But this isn't doing too bad. Alright, and then let's just peek at my options. So I own a bunch of alties. I decided to spread them out across different dates, different strike prices, selling calls on them because I already own them. So I'm selling calls, and really small bid-ask spread. The most I can ask for these is like 5 cents each. So and they're still not filling, and I would put an order in, and then it would automatically not go through, so I had to put another order in the next day. So I just put them all as good till canceled instead of good for day, and then just let them sit. And here are my positions held currently for other options. Okay, alright, so let's get into this Cracker Barrel mess. So see right there, CRBL, Cracker Barrel. So when they did their logo change announcement, and of course, terrible idea. So I'm feeling bearish on this stock, bearish on it. So I put in a credit spread where I received money to enter into that deal. It has 2 option legs on it, a $60 strike price and a $62.50 strike price. And so I made 65 bucks to get into that deal. But now you can see that $1.30, it's going to cost me $130 just to close it. So that's not good. And it's already moved against me. Let's see what that looks like. So let's tap on that. So that lower strike price, $60. If the stock rises above that, that's not good for my position. And you can see right above it, CBRL is at $62.34. Now, why did that happen? Let's look at the past. What is it? When did this happen? Probably right there. Big drop, and now it's recovered because it dropped about 8%, and then it popped back up around 8%. And that's from going from the announcement of their logo change, so their stock tanked. And then recently they said that they were not going to go through with the logo change, which is good. You know, that's a point in their favor, so the stock jumps back up. But, you know, overall, I'm still bearish on this stock because they already spent so much money hiring firms to change their logo, and I mean, they'll save money by not having to go out to every single billboard sign and change it, you know. So I mean that'll save them some money, but the reputation damage from so many people on social media saying they're never going to eat there again, that's going to hurt them, definitely, at least for several months, until those people change their mind or something. And plus, with their store, when you walk into a Cracker Barrel, the first thing you see are like all these things you could buy. So that store accounts for about 1/5 of their revenue, and tariffs are apparently not good for this business because they get most of their stuff from China, and so that's going to increase the prices to people buying the stuff, and maybe they're not going to buy it because the prices are so high. So I'm remaining bearish on this, but I still need to save this credit call spread, which unfortunately I can't roll it. I can close it and I can open up a new one and all that, but I can't roll it. I'm not sure why that little roll button doesn't show up. But what I'm going to do is I'm going to find another call credit spread that would make me more than $65 and try to recoup most of my losses, or maybe make more money in the end. I'm not sure. But if you click on simulate my returns, you can see right here, break even price $60.65, and we're above that. So simulate my returns. You can see on the left side of the screen is the price it is right now, how much money I made, which is negative $61, and the expiration date is in 22 days, DTE, days till expiration. And you can see it curving and then sharply falling way down towards the expiration date, which is roughly a month from now. And if you slide this, let's say the price increases, which is not good for this position, you can see our max loss would be that line all the way down there. So if the price kept rising, I'd be down like 100 something bucks. And if you kept scrolling all the way, I just want to see what this price would be at the very end. Max loss, so pretend it rose a bunch, then it would be a max loss of $184. And I only made $65 to get into it. So, that's not good. So let's see what other credit spreads are out there. So let's click trade, and we will close this. Actually, no. I want to trade view all options. Okay, so you can see that we have this is our current call credit spread that I already put in there. $60 call, we got a -1. That's the one I sold. And then we have a $62.50 call. That's the one I bought. So I sold the low, bought the high. Expiration is September 19th. To undo this, I would have to, instead of selling the low, I would have to buy the low and then sell the high. But let's just look what would happen if we put in a new call credit spread, just a higher strike price. So let's try that. Let's find a strike price, a low one. Let's go back. Trade view all options. Let's go to builder. Scroll down to call credit spread. All right, same expiration date. You can see share price in the middle there, $61.95. And this spread down here, some of these are grayed out because I already own the opposite of at least one leg. So if I tried to get into this, it's kind of warning you, hey, you already have a leg out there, so, you know, what do you actually want to do with this? So what we're going to do is go up to maybe this $65 and $67.50 spread. Let's click on this. So what's going on here? I would have to buy the high, which is $67.50 strike price. I'd have to sell the lower strike price at $65, but I would get a total credit for doing that. Selling the smaller strike price, buying the more expensive one, the higher strike price. Max profit down here, $83. Max loss, $167. So rule of thumb would be, it would be acceptable to spend $1 risking $3 in loss. So like you earn $1, but you're risking $3. So that's that profit to max loss ratio. Ideally, you want to stick to that ratio or underneath it. Like if you're risking $1 to gain, risking $2 to gain $1, risking $3 to gain $1, you know, it's fine. Risking $4 to gain $1, it's pretty iffy, but sometimes that's pretty much all you can find. And anything, you know, less than that, 1 to 5, 1 to 6, it's just not worth the risk, really. But you can see for $83, what would that be? So that's roughly risking $1, risking $2 to make $1. Because the ratio $83 to 167 is 0.497, so that's like 0.5, so 1 to 2. So this is a very acceptable risk. It's better than 1 to 3, which is usually the rule of thumb you want to stick to. So what we're going to do, you can click on there to look at the whole price chart. So there's the price now. If it rises and rises all the way to 6.26%, we'd break even. If it keeps shooting up, we'd lose money. But $83 to get into this is good. So we'll click continue. Go for one of these. Click review. Swipe up. Alright, it's queued for the next day. Awesome. Collateral is $250. Click done. Now let's go back to trade, close. Yeah, that's right. So it says one contract available, which is the one that I already received money to get into. I own that spread. Now we want to close it. Estimated cost to close it is $130. So yeah, it's in the middle. Let's just close it. Alright. And just for fun, let's try and recoup our losses by doing another call spread. Let's go to Builder, Call Credit Spread. Some of these are grayed out. We just did the $65, $67.50 spread. Let's look at higher strike price. It's even safer. You're not making as much money, but it's safer. So let's click on that. Alright, so getting into a new call credit spread. The lower strike price, you're going to sell it. The higher strike price, you're going to buy it. Total credit, 68 cents. So the most you can make on this deal is $68. And this ratio is acceptable to me. It would have to rise a whopping 10% just to break even if it moves against us. So given that I'm still bearish on this, I'm okay with that. Let's click continue. One contract, click review, 250 collateral. You know what? Why not do a couple of these? Yeah, why not? We'll do 3 of them. We have enough collateral to put aside for it, and this will more than make up for our losing position of having to close that lower call credit spread. And the ratio is going to be the same no matter if you put in 1 credit spread or 3. Swipe up to submit. You can't sell an option to open an option that you already have a long position in. Doesn't like that, huh? Alright, we'll go out a month. What do we got here? Alright, yeah, let's do this. Three contracts, further out expiration date, so it's not going to interfere with any other legs we got going on here. Swipe up and queued for next session. All right. Okay, so that's how you manage a call credit spread. And, you know, pretty similar concept if you have other spreads. Just if you bought a leg to get out of it, you're going to have to sell it. If you sold a leg, you're going to have to buy it to get out of it. And then you just roll up or down to different strike prices or out to further out dates. And hopefully you can recoup your losses or at least not lose as much money overall. So that's how we'll manage that. Hopefully they'll execute and be able to save this position. So thanks for watching. Please give this video a like if you liked it and consider subscribing. I'll see you next time.